is 2% the right target? Forget about how you get there, how far away you are, how you screw this up or whatever. Is it the right target to begin with? And then the second part is, how are they doing? Are they getting close to the target? Will the cost of getting to the target outweigh any benefits? Are there any benefits, et cetera? So one's kind of big picture, long term. Where does 2% come from? And then the other one is how they're doing, right now. So in the first one, I've never felt that 2% was the right target for inflation. I always thought it should be zero. If you believe in price stability, you wouldn't want any inflation and you wouldn't want any deflation. You would want price stability. Now, of course, you're never going to get it exactly there, but the target in that world would be zero, maybe a little bit below, a little bit above, but you'd always be steering to zero. That means you're not stealing anyone's money through inflation. Pardon me, you're not enriching creditors through deflation. You're not distorting the allocation of capital by either one. You're just saying we want stable money. That's kind of the Fed's job. So then the question is, why is it 2% if theoretically zero? And I disagree with Milton Friedman on a lot of ways, but a lot of things. But Milton Friedman said zero. He said he didn't think it should be 2%. He thought zero was the right number. I agree with that. So why is it 2%? Well, the Fed has a rationale, but I think it's a bit of a fraud. And then I'll tell you what's really going on. The rationale is every now and then you have to cut interest rates to stimulate the economy, bail out the stock market. You just need a rate cut. And the evidence is pretty good that negative rates don't work. They have been tried for years in Japan, Switzerland, I believe Sweden for a while. And the ECB today. So we do have negative rates, but they don't do anything. They don't stimulate. In fact, they often do the opposite of what they're intended to do. Let me give you a concrete example. So the idea is, if I cut interest rates, lower and lower, as a saver or an investor, I'm going to say, well, I don't like those low yields. I put money in the bank, I only get, a quarter of 1% or half of 1% or whatever. So I'll go buy some treasury notes or I'll go buy some stocks. And that's called the portfolio channel effect. In other words, by keeping rates so low, you make simple savings and liquid investments unattractive, and you drive investors to other investments, housing, stocks, bonds, whatever, commodities perhaps. And then that creates a wealth effect. And if my assets go up, I feel more prosperous, maybe I spend more money, and that helps the economy, et cetera, et cetera. That's the theory. It's all garbage, by the way. There's very little evidence for the wealth effect. I mean, yeah, assets go up, people feel a little better about it, but the idea that they turn around and spend more money is not does not hold up. The people with the most assets tend to have the most discretionary income. And they, once you got a couple of cars and a couple of houses or whatever, are you actually going to, in a decent wardrobe, you're actually going to go spend more money? Well, probably not. You probably save it or invest it. I'm not saying those are bad things, but the idea that it stimulates the economy is not true. But if you follow the theory and say, okay, lower rates force you into asset purchases, et cetera, wouldn't negative rates do even more of that? Because what happens with a negative rate? You have $100,000 in the bank and at a negative 1% interest rate. I'm the government or the treasury, or the bank. I'm taking $1,000 a year. I'm taking 1% out of your account. So you're sitting there. You just say, hey, I just want to save $100,000. That's all I want. But with a negative rate, it goes 99, 98, 97. And the idea there is, well, now you're really going to spend your money because it's kind of use it or lose it. Again, these are the kind of theories, and this is what the literature says. These are the kind of theories these eggheads dream up. But let me kind of ground that in the real world a little bit. What do people actually think? When they see negative rates, people say to themselves, there must be deflation coming. Why would they, the economy must be in really bad shape. Deflation must be getting the upper hand. Why else would they go to negative rates if they weren't worried about deflation? And if they are worried about deflation, and they are, then I'm going to save more. I mean, far from getting people to spend, remember, you're saving, the dollar is worth more. In a deflationary world, your dollars are actually worth more. In real terms, a dollar can be, just a bank account, can be your best performing investment in a deflationary world. If you have 2% deflation, then the real value of a savings account with zero interest goes up 2%. And that's probably better than what stocks are doing in that world. So people act rationally. They say, okay, we have negative rates. Central bank must be worried about deflation. If they're worried, I'm worried, and I'm going to save more because, first of all, that those savings will do well in deflation, I need to be prepared for that. The last thing I want to do is spend. Particularly if prices are going down, why would I spend? I'll wait 6 months to get a cheaper price. So, in other words, real world behavior is the exact opposite of what central bankers predict. Central bankers predict use it or lose it. You'll go spend the money because I'm going to take it away. But real people say, no, I'm going to save more because you're signaling to me that the value of the money is going up because you're worried about deflation. The prices are coming down. So what's the rush? So, so for all those reasons, negative rates don't work. You really kind of go through the looking glass. Now, in theory, cutting rates from 5 to 4 to 3 to 2 down to 0 does perhaps have some stimulative effect, not as much as people think, but some. But why? And so the Fed says, well, we don't want to start with 0. If we start with 0, if that's our target, and negative doesn't work, and the economy goes into a recession, how do we stimulate the economy? We can't go below 0, but we can't cut rates because we're at 0. So they believe that they ought to keep rates around 2%. Now, as inflation is about 2%, interest rates are about 2%. And that gives you 2 points of cuts. You could do in 25 basis point rate cuts, you could do 8 cuts. It's a full year of rate cuts from 2 to 1 3/4, 1.5, 1 1/4, et cetera. You could do 8 25 basis point rate cuts with 2%. So the Fed says we need to keep our target rate is 2% because we need a little cushion in case we have to cut. And if we're at 0, we don't have a cushion, we can't cut. That's what they say. The reality is the following. And the way I explain this, it's like a little kid, like a 9-year-old kid, and his mother leaves her purse around, and the kid goes in the purse and sees there's $50 in the purse. And he says, well, even an 8-year-old will say, well, if I steal the $50, mom's going to catch me and I'm going to be in trouble. But if I take a couple bucks, she won't notice. Like, she's not counting the dollars every day. So I'll just steal $2 because she won't notice. That's the theory. And the Fed's idea is if I steal 2% from you, you won't notice. 10%, yeah, you'll be up in arms. You'll be driving tractors up the steps of the Fed the way they did in 1980. But 2%, you kind of won't notice. Well, what's the math of 2%? 2% cuts the value of the dollar in half in 35 years. That's just the math. It cuts it in half again in another 35 years. Bear in mind, you're starting from down half. So in a typical lifetime of 70 years, at 2%, the dollar is going to lose 75% of its purchasing power. It gets cut in half and then half again in the second 35 years. So in 70 years, typical lifetime, your dollar loses 75% of its purchasing power at 2%. And that's really the point, because 2% year in, year out, probably not enough to feel. It's not like Argentina where they're going to be banging pots and pans. But it's insidious. And by doing it for a long enough period of time, you destroy the purchasing power of the dollar. And that's what they really want to do. Why? Because the federal debt is nominal. I mean, I'm big on, adjusting for inflation, using real rates instead of nominal rates, et cetera. I think that's a critical part of any economic analysis. But debt is nominal. If I owe you $1, I owe you $1. Whether in real terms it's $1.05 or 95 cents, that's separate, but I owe you the buck. Well, if you can destroy the purchasing power of the dollar, you're actually reducing the real value of the debt. So it's one way to pay. People say America has never defaulted on its debt. Well, first of all, that's not true. It's not a true statement. But the easiest, quietest, stealthiest way to default is inflation. It's like, hey, here's your $1 billion back. Good luck buying a loaf of bread because I destroyed the value of the dollar. And so now 3%, we'll do it in, do the math, we'll do that in about 22 years, which means about 23 years, sorry, which means that you'll destroy 75% of the purchasing power in 46 years, not 70 years. So, and so on, 4%, 5%, et cetera. At 10%, you cut the value of the dollar in half in 7 years. By the way, that is what happened between 1977 and 1981, in that 5-year period, the dollar lost over 50% of its purchasing power. A lot of people like to bang the table and say, since the creation of the Fed in 1913, the dollar has lost 95% of its purchasing power. Well, that's a true statement, but you don't need 110 years. We lost 50% in 5 years between 1977 and 1982. So inflation is insidious. It is a tax. It is a form of theft. But like the kid